cap rate is much more common in the commercial world, but I think it's extremely relevant still in residential real estate. Hey everyone, Kevin Amalsh, Pine Financial Group. We work together so you succeed. Hey, you found us here on Facebook, you found us here on YouTube. Please hit like, hit subscribe. We're trying to build a fantastic YouTube and Facebook presence to help more real estate investors just like you. Oh, and leave some comments below. Let us know what you think. Give us some feedback, challenge us. We would love to interact with you. So please leave some comments. One of the topics that seems to be coming up a lot recently is the difference between a cap rate and your return on your investment, or your cash on cash return. Return on investment and cash on cash are actually two different things. So it's cap rate versus your cash on cash return, and when and why you would use either one of those metrics when you're looking at real estate deals. Cap rate is much more common in the commercial world, but I think it's extremely relevant still in residential real estate, single family, condos, that kind of thing. So we're going to talk about that and how it will help you as an investor. So what I'm going to do here is try to go to a screen share and share this little mini presentation that I put together for you. It's fantastic. Seems like it might be working. So the first thing you have to do when you're calculating either one of these is to come up with your NOI, which is your net operating income. It's pretty simple. It's just your income minus your expenses. So when you're looking at a piece of property, what you're going to do is calculate your income. So that's your gross scheduled income. That's going to be what you expect to get for rent per month multiplied by 12. Okay. Then you want to subtract any vacancy factor out there. Typically what we're seeing is somewhere between 3 and 5% because we're in a really strong rental market right now. Now that will creep up depending on how well the market's doing and how the vacancy rates in that area are. But we would subtract the vacancy rate and then add any additional income. So this is more common when you have like laundry facilities or reimbursements for utilities, that kind of thing. And that's how you calculate your income. Then you got to subtract all of your expenses. So I put the main ones up here: your taxes, your insurance, your management. You have your repairs and your maintenance and your utilities, and the other is going to be like maybe some marketing or legal or accounting, that kind of thing. Add all of that to get your expenses and subtract that from income, and that's your net operating income. Okay, so the cap rate, to be clear, a cap rate is what return the asset will produce without any debt. It's really that simple. What kind of a return are you going to get if you paid all cash for the property? So I put in here, to get a property value using a cap rate, you're going to take your NOI, your net operating income, and divide it by the cap rate. So in this example, I use $150,000 per year in NOI. I divide it by a 6% cap rate, which is kind of like what I'm looking for right now. If you have any multifamilies in this range, I'd be probably interested. So that would give us a property value of $2.5 million. Now, to get a cap rate, if you're going to use this formula here, you have to actually pull comps or comparables, other buildings that are very similar, and see what they're trading for. This is only going to apply in 5+ units, because in 1 to 4 unit residential real estate, you're not going to really find cap rates probably when you're looking for comparables. It's just the value, and you use that to come up with the value of your property. So that's one way to get a value, especially again in the commercial world. Now, if I'm going to get the cap rate, if I take the NOI and divide by the value, then I'll get the cap rate. Or you could exchange this value for the purchase price. So NOI divided by what they're asking for the property, or what you're going to offer for the property, or whatever that number is, would give you the cap rate. Okay, cash on cash return. That's actually pretty simple, you guys. You got to get your cash flow. So you start, again, NOI, you start with your NOI and you subtract your debt payments. So your principal and interest payments. Now be careful here on residential real estate, because it's pretty common to have escrows, would be your taxes and insurance, included in your debt payment. So you don't want to subtract taxes and insurance from your NOI and then also have that in your annual debt payment. So just be careful with that. And then calculate your return. You just take your cash flow divided by your investment. So if you take a really simple single family house, let's say it's worth $100,000, you put $20,000 down, a 20% down payment, you would divide your cash flow by your $20,000 down payment plus any improvements or closing costs or whatever other investment you had in there, And that's how you get your cash on cash return. So why are these so important, both of them, so different and so important? Well, the obvious one is one includes the financing and one does not. So your financing and the terms of your financing can significantly change your cash on cash return, and it won't affect your cap rate at all. So cap rate is a fantastic way to look at the quality of an investment or a quality of an asset. Cash on cash return is more of what's the quality of the overall deal, how the deal is structured, the asset, including your financing. One thing I do want to mention when we're talking about cap rates, and what I've just recently was brought to my attention, I thought it was a fantastic idea, is using cap rates to analyze a residential portfolio, a rental property portfolio. So what you could do here is you could determine the value of the properties using comps like you would any other time. So you just look at what do you think the house is worth, use the formula to come up with the cap rate, and then you can use that cap rate to determine if it's worth keeping the asset or not. So oftentimes we would suggest you look at your rental portfolio and decide which properties to sell, which ones to keep, when are you going to roll up to bigger assets, trying to produce higher returns, higher cash flow, that kind of thing. So a really simple way to start at least analyzing your rental portfolio is calculate cap rates and decide, would I buy a property if it's a 1 or 2 or 3% cap rate, which is what this property is producing, or should I sell that, take the equity and roll it up to something like a 5 or 6 or a 7 if you're able to find those types of assets. So interesting twist on the cap rate, using it in residential real estate, but I think it's fantastically valuable. So hopefully you find this video fantastically valuable, and hopefully you subscribe to our channel and you leave some comments below, and check us out for all your real estate investing financing needs at pinefinancialgroup.com.